This video is to cover Chapter 20 exercises in journal entries for government accounting. The problem: the general fund journal entries. The following are transactions related to levying and collecting the property taxes for Jedville Township. So we're going to be in the general fund. Okay. All right. So on March 21st, 2011, the property tax bills for $2.5 million are sent to property owners. An estimated 2% of the property tax is uncollectible. The property taxes are due on May 1st. Okay. So in order to make this journal entry, we're going to do March 21, 2011. And it's going to be property tax receivable. Current. And then so the $2,500,000 is all current. And then a portion of it, 2%, allowance for uncollectible. And that's going to equal 2%. So this is going to be an allowance for uncollectible. And then we have property tax revenue. And it is this minus the allowance. So that is to record a property tax levy. Now, on May 4th, 2011, $1,900,000 have been collected. The remaining receivables need to be classified as delinquent. Okay, so May 4th, 2011. So we've received cash of $1,900,000. So then we must do property tax receivable. So we must remove this receivable. Current for $1,900,000. And then we are going to put the delinquent taxes here. So taxes receivable delinquent. Allowance for uncollectible. Current. So we're going to remove the allowance for uncollectible current taxes. And then we are going to taxes receivable property tax. We're going to remove the receivable for current taxes. And we're going to remove the allowance we're going to add an allowance for delinquent. So now we've removed the receivable for current, removed the delinquency for current, and put them as an allowance for delinquent and a receivable for delinquent accounts. Next, from May 5th to December 31st, an additional $150,000 of taxes are collected. So we don't know the exact date, so May 5th through December 31st, 2011, and we're going to receive cash of $150,000. And we're going to reduce property tax receivable. The delinquent account. On November 1st, 2011, $5,000 tax receivable account is determined to be uncollectible and written off. So allowance for property tax. Delinquent. So basically, to write off we reduce the allowance for delinquent and we reduce the receivables. So that's writing off the delinquent account that we think is uncollectible. January 1st, 2012 to February, we collect an additional $87,750 of taxes. So part 2 says, how will the property tax be presented on the balance? December 31, 2011. Okay. So it would be property tax receivable, delinquent, and it would be 600,000 is delinquent minus this, minus our allowance for delinquent, and it would be net of allowance. And then number 3 says, what would revenue equal? Revenue would equal the tax levy less uncollectible amounts, less amounts not collected within 60 days of the end of the year. Since the government rarely closes its books, within 60 days, this amount would be known. So we have revenue. Equals this much. Less allowance. Less amount not collected by year end. And so the amount not collected by year end is our receivable minus the amount we collected by February, which is $312,250. So property tax revenue for 2011 equals this minus this minus this, or $2,137,750. And this is how you make journal entries for a property tax levy.